Welcome. In today's video, I am analyzing footwear companies like Bata India, Relaxo Footwear, Mirza International, Khadim India and Superhouse Limited. The results for all of these companies are up to date till June 2019 quarter. It is also up to date till financial year March 2019. I'm going to analyze around 40 ratios approximately to understand the health of these companies and also to understand if we can invest at whatever valuation these companies are currently trading at. So I have divided these ratios into 6 different categories like valuation, growth, profitability, cash flow and liquidity. So let us understand by going through each ratio what it would or what it can indicate to us about the overall health of the company. Let us begin with the share price analysis of these companies, and we'll look at the face value and the current market price and adjust the face value for 10 so that we can compare where the price of each share is currently. Bata India's current share price is 1,530 rupees per share and the face value of each share is 5 rupees. So we equalize it to 10, so we have to multiply it by 2. So we multiply 5 by 2 and then 1530 by 2 as well. So we get the Bata India's actual price of 3,060 rupees. Relaxo's current price is 4,671. Its current price is 467 rupees, but the price or the face value of each share is 1 rupee. And we have to multiply this with 10 to equalize with overall all companies. So Relaxo is the most expensive at 4,600 rupees per share. Mirza International's price per share is 54 rupees and the adjusted price is 271. Khadim's is 238 and the adjusted price is also 238 because there is no split in the shares. So Superhouse and Khadim have no split in their face value. Therefore, their current price and the adjusted price remains the same. Next, let us look at the percentage fall in price from its 52 weeks high. That is where the price was 1 year back compared to the current market price. Bata India's 1 year back price was 1,580 rupees per share and currently it is trading at 1,530, so it is very near to its 52 weeks high. That is very near to where it was 1 year back, and it has fallen just 3% from its 52 weeks high. Relaxo Footwear has fallen 10% from 52 weeks high. The maximum fall was seen by Khadim at 68% and Superhouse at 51%. Even Mirza International has fallen 46% from where it was 1 year back. So these falls do create an opportunity, but we have to understand why these companies' prices have fallen so much. And we also have to understand whether the ratios have become worse or have in fact has become better, but the market has somehow discounted these companies. Let us look at the change in market cap over the period of 3 years and 5 years and then compare it with the current year's market cap or the latest market cap. Bata India's current market cap or the entire company's total value in the market is at 19,600 crores, against which 5 years back indicated in the orange bar was 7,009 crores. That is, it has managed to increase its market cap from 7,000 to 19,000. So that's a jump of almost double. Even 3 years back, it was available at 7,299 crores in the market. So it has managed to gain a market cap from where it was 5 and 3 years back. Relaxo also has managed to gain it in its market cap from both 5 and 3 years back period. Mirza International has seen a drop in its market cap from 3 years back and from 5 years back. 5 years back, the entire market cap of the company was 805 crores, and currently it is available at 651 crores. In fact, 3 years back it was available at 1000 crores, and now it is available at 651. So we have seen a drop in its entire market cap. So this would definitely indicate to us that somehow the market has discounted these companies, and we need to find out the reason why the market participants would discount these companies. Khadim has been recently listed in the market, so we don't have the 5 and 3 years data available with us. But currently it is available at 428 crores. So these are quite small compared to the other two companies that we are going to also analyze, like Bata India and Relaxo, which are about 10,000 crore companies. Superhouse is an 86 crore company. The entire market cap has almost eroded. 5 years back, the entire company was available at 238 crores, and 3 years back it was available at 164 crores. So we can see that the market cap has fallen quite considerably from 5 and 3 years back. Also, this can indicate to us a fall in the price, because market cap is nothing but the overall value of the company divided by the number of shares would give us a price of each share. So let us see how the prices have fluctuated over the period of 1 year, that is 52 weeks back, which we have already analyzed in the first or second graph, and then see how or where the current price is compared to 5 years back and 3 years back. Bata India's price 3 years from 1 year back, in fact, has fallen by 3%. But from where it was 5 years back, it has increased by almost 2 times, or 198%. And from 3 years back, it has increased by 186%. So we don't want the prices to increase at a very high rate, but at a reasonable rate over a period of both 5 and 3 years. For example, if we want to buy into a company from where the price was 5 years back, so we can expect a nominal gain in price of say 50% every year. So in this case, the company's price over a period of 5 years have increased by approximately 2 times, or 200%. And in the recent 3 years also it has increased by somewhere around 1.8 times, or 186%. So this is a good growth rate. We are not buying very expensive in terms of where the prices were trading 5 and 3 years back. So in 3 years it has increased approximately 1.8 times. That is, every year it has increased at the rate of 60% approximately in 3 years, and in 5 years it has increased at the rate of 39%. So from 5 years back we are getting at a decent growth rate. We are not paying very high price compared to where the price was 5 years back. Relaxo has fallen 10% from 1 year back price, but has gone up by 210% from 5 years back price, and 102% from 3 years back price. So from 3 years we are getting it at a good margin. Every year it has not gone up by much percentage, and in 5 years also we are paying a not very high percentage. Say max to max it would be 210 divided by 5 years. That would be 42% of growth rate. For me, anytime from 5 years back, if the prices are going up more than 50%, then I would generally wait for buying into the company. I don't want to pay more than 50% growth rate in price over a period of 5 years, or even in fact over a period of 3 years. So only when the price comes below 50% in growth rate, I would want to buy into the company. Mirza International price has seen a 46% fall from 1 year back, and 14% from 5 years back price, and 33% from 3 years back price. So it has fallen in fact above all the three levels that we have selected: 52 weeks high, 5 years back, and 3 years back. So this has fallen in fact below all the prices. Khadim India has fallen 68% from its 52 weeks high and 66% from 3 years back. Superhouse has fallen 51% 52 weeks back, 62% from 5 years back, and 82% from recent 3 years. So the market participants have highly discounted these companies in the share market. Let us look at the earnings yield percentage, that is, what was the profit companies earned on the current share price. So whatever price we paid for the share, on that, what was the profit these companies were earning? Or rather we can say that if we would want to buy currently at 1530 rupees for Bata India, then we can expect at least in the last year the company made a profit per share of 27 rupees. That's just 1.8% on the price we paid. So this is quite low. For example, if you had paid the same 1530 and taken a fixed deposit for a year's time, we would expect somewhere around say 6 to 7% at least of interest, that too risk free. So here too, when we are paying a certain price for the shares of the company, we should expect at least a certain risk free return that we should get from our investments. Relaxo Footwear's yield was also very low at 1.6% because the price was quite high compared to the earnings per share provided by the or earned by this company. Mirza International, because the price was very low compared to the earnings of the company, the yield increased to 6.2%. Khadim's yield was around 4% and Superhouse yield is 22%. This is because the company's price has fallen quite a lot against the earnings per share. So here we want it to be as high as possible so that we get a good deal when we are buying into these companies. Next, let us look at the price to earnings ratio. This is the price we paid for the earnings of the company, or how many times more we are going to pay against the earnings of each share. The price for Bata was 1530 rupees per share, on which it earned 27 rupees. That's a 56 times multiple. That is, for earning 27 rupees of profit every year, we are going to pay 1530 rupees, which is a 56 times more. We should not pay more than 25 times the earnings of the company. Relaxo had the highest price earning multiple of 64.7 times. That is on a price, or rather that is on an earnings of 7 rupee 30 paise per share. Investors were willing to pay 467 rupees. The lowest price earning multiple was for Superhouse, whose earnings were 17 rupees and each share was available at 78 rupees. That's a multiple of 4.5 times. Next, let us compare the price earning we paid for the latest 12 months against the 5 years average PE and 3 years average price earning. Bata's, as we saw earlier, investors were willing to pay 56 times, whereas in the last 5 years it was quoting at around 41 times its earnings, and in the recent 3 years it was quoting at 43 times. So the current price earning has gone way above its averages of both the 5 and the 3 years. The highest price earning we saw was for Relaxo at 64 times, but in the recent 5 and 3 years also it was quoting below that at 42 and 47 times. The lowest price earning multiple we saw was for Superhouse at 4.5 times, but in the last 5 years it was quoting at 8.1 times, and in the recent 3 years it was quoting at 9.4 times. So we are getting it at a discount, and at quite a high discount of almost 50%. Khadim also saw a below its 5 years as well as 3 years price earning. That is, the current price earning is below both its 5 and 3 years average. Even Mirza International has gone up slightly above its both 5 and 3 years averages. So here we want to understand how the company's price has been trading compared to the earnings through the last 5 and 3 years as well as in the latest year, and how the latest year's price earning is comparing against both the 5 and 3 years. That will give us a good idea as to whether Bata, for example, has always been trading at such high multiples, because my benchmark is 25 times. So if not all companies would come under that category, so we have to look at how it has been trading over a period of 5 and 3 years, and then take a call regarding the price to earnings. Also to keep in mind regarding price and earning is to, after looking at price earning, we have to compare that with the profit growth rate. That is, if you are paying say a certain multiple against the earnings of the company, then how fast that earnings is growing, that also needs to be taken into consideration. That we will look at when we look at the PEG ratio, or price earnings to profit growth rate ratio. So here we should not pay more than 25 times generally, but many stocks which are quoting about 25 times, or in a way we can say the market participants have given a premium for their shares, or are quoting these shares at a high multiple, or even are willing to buy at such a high multiple, then there has to be some reason for why these companies are trading at such high multiples. Next, let us look at the comparison of earnings, CFO and FCF. Earnings is the profit of the company, net profit per share, against which we want to understand how much of this profit that the company is saying it has earned, how much of it has actually got converted into cash through operating activity. And of that cash that the company has earned, how much is left over as free cash. Free cash can be calculated by removing out the investing or the cash invested in assets from the CFO, or cash flow from operations. So once we remove the investing portion of the cash from CFO, we get the free cash flow, or FCF. So to recap, we are just looking in this ratio, we are trying to understand what is the profit the company has earned for each share. Out of that profit, how much has actually got converted into cash, that is how much the company has actually received in cash, that profit, and out of that cash, how much was invested in buying assets, and how much was left over as free cash to be used in the financing activity. So Bata India's earnings per share, or profit per share, was 27 rupees, and almost all of it has got converted into cash. That is, it has received a cash of 26 rupees, and out of the 26 rupees, 20 rupees is still left over as free cash to be used in the financing activity. Now financing activity would include your buying, doing buyback, or giving out bonus shares, or doing acquisition, or repayment of loans, and many other things that can be included in the financing activity. So here the Bata has done quite well in keeping all of its ratios in terms of earnings, CFO and FCF in a proper order. Relaxo had shown a profit of 7 rupee 30 paise per share. Here I'm looking at per share values, and out of that 7 rupee 30 paise, only 5 rupees came in as cash, and even out of this cash, only 1.30 paise is left over as free cash. So the balance of 5 minus 1.3 was used to buy assets in the latest year. These data are of all of 2019. So we want to look at something like what the Bata has shown, that company earning profit, the profit getting converted into cash, and most of the cash being still there in the books of the company. Now, regardless of what it does with free cash is a secondary matter. That is, either it could repay the loan or do a buyback and so on. Mirza's profit was 3 rupee 30 paise. Out of that, 2 rupee 90 paise has come in as cash. That is lower than the profit the company showed. And out of that cash, all of it was used to buy assets. And over and above that, additional 2 rupee 80 paise was used to buy into the assets, additional assets. So company has invested more than what it earned in cash into buying of assets. So I don't like this kind of situation where the company is buying more assets than what it is earning in a cash in 1 year. Khadim's case is a little different. It has earned a profit of 9 rupee 50 paise, and it does not have any cash to show for that. In fact, it has a negative cash, that is, cash is going out of the business. Here I don't like to invest in a company which has a negative cash from operations. Now this is okay, but then again 19.2 rupees per share was invested in assets. Not only has the company not received any cash for the profit that the company has shown, but over and above that it has invested 19.2 rupees for every share in buying of assets. Now why would the company invest such a huge amount in buying of assets when it is not receiving any cash from operations? Now if there is a growth in the company, that is understood, but would that growth be sustainable? That needs to be looked at. So that as we go on below and we look at the 5 years data of how the company's ROE, ROCE and asset base, how they are growing, we'll understand whether this is justified, whether Khadim's free cash being negative is justified or not. Superhouse profit was 17 rupees and the cash coming in was almost double of that at 34 rupees, and out of that 34, 24 rupees is still left over as free cash. So even Superhouse has done well in terms of converting its profit into cash and keeping maximum of its cash as free to be used in financing activity. Next, let us look at the price to OCF ratio. These are all valuation ratios, and here we are trying to understand how many times more we have paying for the or against the cash coming in through operations. Earlier we saw that what was the price we paid for the earnings. Now we are looking at what is the price we are paying for the cash earned through operations. Bata was available at 57 times its OCF. That is, the cash earned through operations was 345 CR. This is the total value that I have considered for the CMP, that is the current market cap or total market price of the company, and the total operating cash earned in crores. As I mentioned, the cash the company earned was 345 crores, on which the current company's total price was 19,671 crores in the market, which is like a 57 multiple. I again don't like to pay more than 25 times the OCF. This would suggest a very high valuation. I would wait for the price or the market cap to come down, as the case may be, to buy into the company. Either the market cap may come down or the cash earnings may go up. Regardless of that, if the multiple drops to below 25, it seems reasonable. Relaxo's price to OCF multiple was very high at 93 times. Why would people want to buy into a company where the cash coming in the latest year was 123 crores and the entire company available was at 11,000 crores? So that's a very high multiple. We need to wait for the price to OCF to come down. Not only, as we saw earlier, price to earnings is high, but even price to OCF is high. Mirza's price to OCF is available at 18 times. Generally, if the companies have some internal issues or if the prices have come down for whatever reason, then the ratios do come below 25 times. But then if the company's ratio has come down because of some problem in the company, then that itself is not a buy indicator. We just want the price also to come down, but at the same time the ratios of the different metrics, like as I mentioned earlier, like profitability, growth, they have to be still intact for us to buy. The valuation will just help us understand if you're paying more or less. But then if the valuation is low but the company's profitability is not there, company's liquidity position is not good, or company's growth is not good, so then what is the use buying into this company? So it is better to avoid when we're getting it cheap. Cheap does not necessarily mean good, and a high price stock also does not necessarily mean that it's a good buy. It's just that maybe the price is already or the price is already discounted for the future growth. Khadim's OCF is negative, as we saw earlier. Company was had a cash outflow from operations of 11 crores in the 2019 against the profit that the company showed. So here I just want to put a question here, is if the company has shown a profit of 428 crores, what does it have to show in cash for that profit? Nothing. In fact, 11 crores has gone out of the business. If someone wants to analyze why 11 crores has gone out of the business instead of coming into the business like in Bata and other companies, we have to look at the cash flow statement and understand the individual entries as to why there's an outflow of cash from operations. Generally, we should not invest in a company whose cash from operations is going out of the business, either in 1 year or over a period of 5 or 3 years for that matter. Superhouse, on a total market cap of 86 crores, the company has earned 37 crores of cash, which is a 2.3 times multiple, the lowest available. So here we want to buy at the lowest multiple. Again, the caveat is that the other ratios, all ratios that we are considering, have to be in their proper order or within their benchmark. Next, again, valuation wise, we are trying to understand in terms of free cash flow, where is the price? So Bata India is available at 74 times its free cash flow. Again, a very high multiple. Here too, I want it to be below 25 times. Not all companies we will be able to search that we are searching for would give us such multiples. Even Relaxo is available at a very high multiple of 361 times its free cash flow. So here too we are looking at the complete values of the market cap as well as the free cash. Mirza's was again a negative free cash, meaning the company didn't have any free cash in 2019. In fact, it had an outflow of 33 crores against the total market cap of 651 crores. Khadim too had a negative free cash of 35. So what a negative free cash means is that if the company has earned a certain profit, and of that profit let's say company has earned a profit of 100 and the company has received cash of also 100, but the company has invested more than 100 rupees in investment or buying of assets, then the company would not have any free cash or would have a negative cash because it has used up all of its cash into buying of assets. So this is the scenario here when we say 35 crores has gone out or 35 crores of free cash. It means that the company has spent more cash than what it earned through operations in buying of fixed assets. Superhouse had the lowest multiple of 3.2 times. It still had 27 crores of free cash against the market cap of 86. Regardless of whether we use the total value or per share based value, these ratios as such will not change. Next valuation ratio we are looking at is the price to book value, which most of the investors are familiar with. Here we are looking at what is the market price or what is the shares market price against what is the shares actual value after we sell assets and pay off all liabilities. So the book value or the net worth is the actual value of the share against the market value of the share. So we are comparing the market value with the book value, that is the actual value with the market value. And again we are looking at a per share based value here. So Bata's each share was available at 1500 rupees per share, whereas as per the company each share was worth only 135 rupees. That is, if the company sold all its assets and paid all its liabilities, then whatever balance the company has remaining with it, and if distributed between all the shareholders, this is what each share would be worth at 135 rupees. So here we are paying a multiple of 11 times. Generally I would not want to buy by paying more than 2.5 times the actual price of the share or actual book value of the share. Even Relaxo Footwear is available at a very high multiple of 10.5 times. Mirza, Khadim and Superhouse, all three are available at a reasonable below 2.5 times price to book multiple. Next, let us look at the sales and how far away the price is compared to the sales. Here we are looking again at the total value of sales and market cap. We can also do it by dividing it both the market cap and the sales by the total number of shares to get the per share value. But in this case I have let it be and I have used the total values of both the price and the sales, that is the market cap and the sales. Bata's total sales indicated in orange was 3000 crores, on which the total market cap was 19,000 crores. So it was 6.5 times away or away than the sales. So we don't want to pay such a high multiple for the sales. Even if the sales was say very high compared to the market cap, that would suggest a good buy. Generally I would want to pay as near to the sales as possible. Relaxo also was available at a 4.9 times multiple of the sales. Mirza was available at a discount. In fact, all the other three companies, Khadim and Superhouse, were available at the discount to their sales. That is, their sales were more than their market cap. In fact, Mirza's total sales of 2019 were 1,100 crores, almost 1,200 crores, on which the company's entire market cap was just 651 crores. So it was trading even below its market cap or even below its sales. Same was with Khadim, where its market cap was trading at a discount of almost half of the sales. The highest discount was of Superhouse, where the sales were 575 crores and the current company is available at just 86 crores. So this needs to be investigated. This is, although I've given it a positive valuation, because in terms of valuation this is very good, but why would the company who has a sales of 575 crores get a discount in terms of its market cap? Why would the market cap participants discount it such a high value compared to the sales, that needs to be investigated. It is for no reason that the market participants have discounted this company at such high value. Next, let us look at the product of price earning to price book. This product or this ratio rather was developed by Graham, and he mentioned that we should not pay more than 22.5 times when we do a product of both of these. And in this case, the price earning that we can pay should not be more than 15 times, and price book should not be more than 1.5 times. Now, when we multiply 15 by 1.5, we get 22.5. So this is what he's suggesting, that if someone is conservative and don't or wouldn't want to buy at a high valuation, then they can wait for a PE of below 15 and a PB of below 1.5. As you saw earlier, my benchmark was 25 for price earning and 2.5 for price book. Many stocks would not be available at such a steep discount where the Graham formula is quoting at. Bata's total value of PE multiplied by price book was 636, 56 price earning and 11 price book. When we multiply both of them, we get 636, which is a very high value. And according to Graham, this is not a buy. Same is with Relaxo at 678, not a buy. Both price book and price earning are trading at a very high multiple. Mirza is available at 17 times, that is 16 price earning and 1.1 times book. So that's a product of 17. Khadim is expensive at 37 times. Although the price earning is at 25 and the price book is at 1.5, it is still high as per Graham. And Superhouse is quoting at a 1.3, the lowest one, where both the price earning and the price book were trading at an extreme discount. Next, let us look at the growth in profit of 5 years, that is over a period of 5 years, how the profits have been growing for these companies, as well as for 3 years. This would allow us to understand whether the company has a margin, enough margin on their sales, and are they able to grow that margin. Bata's last 5 years indicated in green, the profits have been growing at 10%, and in the recent year the profit has further increased, that is the growth in profit has increased to 25%. This is not the profit margin but rather the growth in that profit over a period of 3 years and 5 years. Relaxo also has seen a good growth of 21% since last 5 years, and in the recent years, although it has slowed down, it is still good at 14% in profit growth. So here I want the profits and sales both to be growing at least 10% and above. Mirza, last 5 years the profit growth rate was 1.2% compounded, but in the recent 3 years the profit has seen a degrowth of 14%. So we want the, as I mentioned earlier also, the profits and sales have to be growing rather than seeing a degrowth. So whenever we see a degrowth, then of course the market participants would discount the price and bring the price down to match with the fall in profit or fall in sales. Khadim 5 years data of course is not available because the company has just been listed, but in the recent 3 years it has seen a fall in its profit by 6.5%. That is, where the profit was 3 years back, from there the profit has been falling compounded at 6.5%. Superhouse has seen fall in both 5 and 3 years. In the last 5 years, that is where the profit was 5 years back, from there it has fallen 10% today or in 2019. And in the recent 3 years, that is from 2016 to 2019, the profit has seen a fall of 8.8% compounded over the last 3 years. So this is of course not good. So now we can slowly understand that why the valuation wise these companies are available at such a low multiple, because we can see that the profits has been falling or having a degrowth since last 3 years and last 5 years, whereas Bata and Relaxo in comparison to these three companies has seen a growth of 10 to 21%. So the more growth rate in profit, the higher the would be the multiple. Let us look at the price earning and compare it with the earnings growth rate or profit growth rate over the period of 5 years. This would help us understand that the price earning multiple we paid earlier for these companies or we are going to pay for these companies, is that justified? So when we pay a certain price against for the earnings of the company, we also want the earnings to be growing steadily in the future years as well. So here we have taken the historical growth rate of profits of the last 5 years, looking at how the profits has been growing since last 5 years and projecting that same growth rate over the future 5 years to understand how, if we are paying a certain multiple, how fast we'll be able to recover that capital. If certain explanation or certain ratios are not clear, do let me know in the comment section and I would be glad to help you out and make it more clear if possible. Bata was the price earning that investors were willing to pay for this particular script was 56 times its earnings, and that earnings is growing at 10% every year since last 5 years. So if you look at the PEG, which is calculated by dividing the price earning with the profit growth rate of 10%, that is 56 divided by 10, we get 5.6. Now we don't want to buy a company's stock if the PEG is above 1.5 times. That is a high multiple. So we want not only to pay, even if you're paying a high multiple, for example, like for in Bata India, if it's 56 times, even if you're getting a growth rate of 25%, that would still be justified, that we are going to pay such high multiple and we're getting a high growth rate in profits. Relaxo, the price earning multiple is 3 times. So even if you look in terms of Bata and Relaxo, the Relaxo's PE multiple was higher than Bata's. Price earning multiple for Relaxo was 64 times, but it had also a high growth rate in profit of 21%. So the PG is even below Bata's. So this is much better buy than the Bata stock of by paying 56 times. So we pay 64 times the earnings and we're getting a 21% growth rate in that earnings. So that is much better than paying 56 times and getting a growth rate in profit of 10%. Of course, this 10% is the past data, that is the growth rate in profits over the past 5 years till 2019. So we are just using this as a benchmark to understand if we can expect the same growth in profits over the future years as well. So this is just a projection of the profit of the past into the future. We are not taking or we are not assuming anything here. We are taking the actual growth of the past 5 years and we are trying to project it over the future years. If at the same rate, if we have invested the money and if that money is growing profits at the same rate of the past 5 years, then how many years would it take us to recover our capital? So that's the whole basis of this analysis. Mirza, we're paying 16 times, but the growth rate in profit is just 1.2%. So the multiple of PEG shoots up. So we don't buy when the PEG is at such high multiple of 13.9 times. So even paying 16.2 times is very expensive when that earnings itself, for which we paid 16.2 times, is not growing in the last 5 years. Khadim's, of course, 5 years multiple we don't have of the profit growth rate. Although the price earning multiple was 25 times in the recent 12 months, but that, because we don't have the data, it is not possible to calculate the PEG. Superhouse, the multiple we are paying at 4.5 times, but here if we look at very carefully, the last 5 years the profit has is seen a degrowth of 10%. Now why even this is very high? Then even 4.5 times multiple is not a cheap multiple. So when we are paying 4.5 times and we are not for this for a certain earning, and that earning is falling continuously since last 5 years, then we cannot expect to recover our capital in this case. So we have to wait for it to turn positive for 5 years, let the profit growth rate turn positive, and then we can buy into the company. Till that time we have to avoid even this 4.5 times of multiple. So although we saw earlier that the multiples for these three companies were very low compared to Bata and Relaxo, but now it's becoming more and more clear as to why even these multiple low multiple below 25 times is very high, because the profits are not the earnings are not growing accordingly to the that the multiple we paid. So even if a low multiple but the profits are not growing, don't buy into those companies. Again, we can project the last 3 years profit growth rate and use the current price earning and look at how, if we had bought in the recent if we have bought at a certain price earning multiple, how fast can we recover using the last 3 years projected profit growth rate. Bata's earned price earning multiple of recent 12 months was 56 times. As you already know now, that investors were willing to pay 56 times the earnings of the company. Now that earnings, against that earnings, in the recent 3 years, the profits have grown faster at 25%. Now the PEG has fallen to 2.3. Now it is much better, but still it is above 1.5 times. So as I mentioned earlier, if the profit growth rate was 20%, it would have been better. But this is good. Now it is good. Let's look at Relaxo in this case. The PEG is 4.6. In the previous chart of the 5 years, we saw Relaxo was much better than Bata. But when we compare the recent profit growth rates of 3 years, we see Bata is much better than Relaxo because it is available at 56 times lower than the price earning multiple paid for Relaxo, but also getting a higher growth rate in profit, whereas Relaxo's growth in profit has dropped to 14% and the PEG has increased to 4.6. So this is how we compare the PEG and understand whether the price earning multiple we are paying is justified or not. Mirza paid 16 times but saw a degrowth in profit of 14%. We should not buy into such companies till the time the profits are growing in a positive values. Same cases with Khadim as well as Superhouse, where all the three companies in the recent 3 years have seen their profits falling below its 3 years past, that is of 2016. And all of these have a negative PEG. Never buy into a company which has a negative PEG, because that shows that you'll never be able to recover your capital for which you're paying a certain multiple. Next, let us look at the sales growth rate of the 5 years and the recent 3 years. Bata India has grown its sales at the rate of 7.2% in the last 5 years and 6.6% in the recent 3 years. Although I would like the growth rate in sales to be more than 10%, we can take an average of the sales growth of all these 5 companies and use that also as a benchmark. Relaxo saw a 14.2% growth rate in sales over the period of 5 years compounded, and this is good growth rate. Even in the recent 3 years, it has seen above 10% of growth rate. So both 5 and 3 years, although in the recent 3 years it has slowed down a bit from the last 5 years. Mirza International also saw a healthy growth rate of sales in the recent 5 years at the rate of 10.3%. But in the recent 3 years, the growth rate has slowed down to 7.6%. Khadim India, we don't have the 5 years data, but in the recent 3 years or the last 3 years, the sales has been growing at 14.4%. Superhouse has seen its sales dropping or the sales degrowth of 2.3% every year since the last 5 years. And in the recent 3 years too, we have seen a degrowth in sales from around by 1.3%. So Superhouse definitely has seen a degrowth in both its sales and profits from last 5 and 3 years. So definitely we don't want to invest in a company whose both sales and profits are degrowing. Let us look at the return on equity, or what is the net profit these companies have generated on the shareholders' equity, or on our money that we have contributed into the company. Bata's ROE over a period of last 5 years has been at 17.5%. So this is an average percentage profit the company is earning on shareholders' money. In the 2019, the company had earned 20%, so which is above its 5 years average. So that's a good indicator. Even Relaxo over the last 5 years has been generating around 23% of net profit on shareholders' contribution. In the recent 2019 year, the ROE is 18%, although below its 5 years average. The return on equity is still good. I generally would like my companies, or companies that I would want to invest in, to generate at least a 15% of ROE, because if I had put in the same money into a bank or taken up a fixed deposit with a bank, the bank would give me, say, approximately at least 7 to 8% of interest on my fixed deposit for, say, even if I take it for 3 years. That would be the return that I should expect risk free. Here, I am taking a risk as well, in the sense that I may not receive dividend, or the prices may go down, or even the company may close down in the future. So there's always a risk. So I'm expecting at least double of what I'm getting in fixed deposit. Mirza International last 5 years has generated 14.4%, below my benchmark, and in the 2019 year it has generated just 8.2% of ROE. So the lower it is, the weaker the stock is. Khadim's last 2019 data is showing 7.6% of ROE, again a very low value. Superhouse has given 8.1% ROE over the last 5 years, and in the recent year it has just given 6.9%, even lower than its 5 years average. So even the 5 years average, if you take of the last 5 years, we're getting a 15.8% of average return on equity of these 5 companies. And if you take for recent 2019 year, the average works out to 12.4% for all of these companies. So definitely all these three, Mirza, Khadim and Super, are below the benchmark of 15%, as well as below the averages taken out for these 5 companies. Let us look at the return on assets or profit these companies have generated on the total fixed assets of the company, along with the working capital. Now, the working capital is basically composed of the current assets minus the current liabilities. Current assets are those assets which the company has to dispose of, or would sell off in the current year. And current liabilities are those liabilities which the companies have to pay off within the current year. So we take the fixed assets, we take the working capital change, the difference between the current assets and current liabilities, and look at what is the EBIT these companies have generated on the total assets. Bata's ROA was 26.6% over the last 5 years. So it is deploying its assets very well and generating a good return on those assets. In 2019, it generated 30%, even higher than the average. So now we begin to understand that why Bata and both Relaxo are quoting at a high valuation. That is because these companies are generating or managing their resources, their assets, their equity contribution very well. Relaxo has generated 27.8% over the 5 years and 25.7% in 2019. Again, a very high return and a good return. Mirza's last 5 years average ROA was 19%, and in 2019 it generated 12%. Here ROA also has to be above the average, or at least above 15%. So all of these companies have generated low ROE in 2019. Mirza, Khadim and Superhouse. Has generated just 10% on its total assets employed into the business. Next, let us look at the ROCE, or return on capital employed, over the last 5 years on average. This is the total source of funds these companies have received, either through equity or through shareholders, or through borrowings, that is from banks and financial institutions, or through any other external sources. And then on that, how much is the profit these companies have generated, both for last 5 years on average as well as in the recent year of 2019. Bata's ROCE over the 5 years average is 16.3%. Again, ROCE should also be above 15% at least, and or it should be above the averages of these 5 companies. ROCE for Relaxo also was above 15% for both 5 years as well as in 2019. Mirza, Khadim as well as Superhouse all have seen a very low ROCE. That is why these companies have been discounted so heavily in terms of price. The prices have dropped not because these companies are going through some problem, but because the numbers are themselves not matching up. So the numbers themselves show up a story of the company or the health of the company if we look carefully at all these ratios. Now, ROCE for Khadim is showing 207.3%. Whenever certain ratios, if they show a variation from a normal range, that would need to be investigated. We cannot take it at the face value. We should investigate why ROCE of the 5 years is showing such a high percentage. Let us look at the total capital employed into the business in the last year, and on that what was the sales generated. So here we are trying to understand, if the company has employed 100 rupees of total capital, how much sales it is managing to generate on that 100 rupees. So Bata has this here I'm taking the total value of the sales as well as capital employed. Sales is indicated in orange and capital employed is indicated in green. So the total capital employed into the business was 1700 crores. On that it generated a sales of 2900, so more than what was employed into the business as capital. So this is very good. We want the sales to be as high as possible and above the capital employed as far as possible. Even Relaxo has managed a good sales turnover on the total capital employed of 1.9 times. In fact, all of these companies have generated higher sales than what was employed as capital in the business. So here there is no particular benchmark, but we want the sales to be even higher than the capital employed, or as high as possible over the capital employed. Next, let us look at the net profit of the last 5 years and how this net profit has, or how much of this net profit has actually got converted into cash coming from operations. So here we are trying to understand, has the company received cash for the profit these companies have shown in the P&L account. Bata had a total net profit of 1112 CR, against which it received 1085 crores in the last 5 years. So that's just a 2% of shortfall, but I would like that the profit would actually get converted, entire profit should get converted into cash. Relaxo saw a 7% higher cash coming in against the net profit. So this is good. Mirza had a shortfall of cash by 5%. Khadim received 43% higher cash than the profit, and Superhouse profit was almost twice of the profit declared by the company. So here we want the cash coming in through operations to be more or at least equal to the net profit. So overall in the last 5 years, most of these companies have done well in terms of generating higher cash. Out of this cash generated through operations over the period of 5 years, how much is left over as free cash flow and how much was invested in purchase of assets for these companies? Bata India's cash coming in was 1085 CR over a period of 5 years, and of that the company's total free cash was 706 crores, and only 30% was used up in buying of assets. So this is good. We don't want the company to utilize most of its cash into buying of assets until and unless the company is in a genuine growth stage. Relaxo cash coming in was 725 CR, and the company has 170 crores of cash free for financing activity remaining with them. That is, 77% was utilized in buying of assets. I don't want the companies, or at least the companies that I want to invest in, to be using more than 50% of the cash generated through operations into buying of assets. So once 50% is used in buying of assets, the balance 50% could be utilized in financing activity. Mirza International's cash was 313 CR, and only 47 CR is left over as free cash, and 85% of that cash generated from operations was utilized in purchase of assets or in investing activity. Khadim has utilized 51% of its cash into purchase of assets and has 66 CR left over as free cash. Superhouse too has managed to invest around half of what it earned in cash into buying of assets. So these companies have done well. Relaxo and Mirza have utilized a big portion of their cash earnings in investing activity like purchasing of assets. Next, let us compare what was the free cash flow in the latest year and what was the free cash flow average of 3 years and 5 years. So this would give us an idea as to whether the free cash has been increasing or decreasing when compared to the 5 and 3 years averages. Bata's current cash flow or current year's cash flow was 262 CR, higher than what it was earning in the recent 3 years as well as recent 5 years. So the cash generated through operations is going higher than all its 5 and 3 years averages. Relaxo's current free cash flow is 32, whereas in the last 3 years the free cash flow was 56 CR, and in the 5 years it was 34 crores. So it has gone below its averages. Mirza's free cash flow has become negative in 2019. Even in recent 3 years it had a negative free cash of 12, and in the period of 5 years it had a positive free cash flow of 9. So this is not a good sign, the free cash going negative and negative. Khadim's cash flow also has seen the same downfall in terms of from 13 crores over a period of 5 years on average, it has fallen to 35 CR, negative 35 CR in 2019. Superhouse cash or free cash in 2019 was 27 and above its 3 and 5 years averages. So this is good. So both Relaxo, Mirza and Khadim, all three have seen a shortfall in terms of or their free cash flow, current free cash flow being below the 5 and 3 years. Next, let us look at how much of the net profit was converted into cash in the recent year. Initially, or in the previous charts, we have seen how the cash or how the net profit got converted into cash over a period of 5 years. Whereas in this chart, we are looking at the current year's conversion of profit into cash. This is very important to understand. If the company is showing 100 rupees of profit, is that profit being received in cash by the company, or is it just a paper profit? Meaning, for example, if the company has shown 100 crores of revenue and it has not received much of that by from their customers, then that's of no use. Then that would mean the debtors are increasing and the revenue generated and the profit accordingly is just paper profit until and unless those debtors pay up or the companies receive payment from those customers or debtors. So let us look at how the net profit has got converted in the recent year in cash. Bata's current year profit shown was 331 CR, against which it received a cash of 345, a 4% increase in cash over its profit. So this is good. We want the cash to be coming in against whatever the company is showing as profit. If the cash doesn't come in, then that profit is just a paper profit. Relaxo has a 175 CR of net profit and the company received 123 crores in cash. That is a 29% shortfall. So I don't want to look at a ratio which is negative and which is even a high negative. Mirza's conversion of profit into cash has seen a shortfall by 27%. Khadim saw a huge shortfall of 151%. In fact, the company's profits were 21 CR, but the company has not received anything in terms of cash. In fact, 11 CR more went out in terms of cash from operations. So, a huge shortfall in cash. Superhouse cash was almost twice of what it earned as profit. Next, let us look at the total PAT of 12 months and how it compares over its last 5 years average. Here we are taking a profit after tax of the recent 12 months. Bata's profit of the last 5 years was 222 CR on average, and in the current year, or at least in the recent 12 months, it has managed to earn 348 CR of net profit, so which is 56% above its 5 years average. So this is what we want to look at, that the current year's net profit, or at least 12 months net profit, is above its 5 years average. Relaxo's profit also saw a above average. Mirza International saw below average profit over its 5 years average. So in the last 5 years, the company's profits were 66 CR, and in 20 or whether in fact in recent 12 months the profit was just 40 CR, which is a 39% of shortfall, or below 39% below its average. Khadim's also saw a below average profit of 9%. Superhouse's profit was 4% below its 5 years average. So we want to see a high growth or high percentage above the average. Next, let us look at the YOY growth rate, that is the profit earned in 2018 against profit generated in 2019. Bata saw a 47% growth YOY in profit. So from 225 in 2018, the company managed to earn a net profit of 331 CR. Relaxo saw a 9% YOY growth. So we want a good growth rate sequentially as well. Mirza saw a drop of 39% and Khadim saw a drop of 42%. Superhouse profit went up from 10 CR to 19 crores. So that's almost a double growth rate in profits. Next, let us look at the very near-term picture as to what is happening in the quarterly analysis. Here we are trying to understand the growth rate in sales quarter on quarter, that is June 2018 to June 2019, both in terms of sales and profits. Bata's sales increased by 11% sequentially YOY and 22% growth rate in profit. So this is very good. Again, as in annual growth rate, I want the profit and sales to be 10%. Similarly, quarterly analysis too, I would want the sales and the profits to be growing at above 10% at least. Relaxo saw a sales growth June to June of 15% and an 8% growth rate in profit. Mirza saw a growth rate in sales but a degrowth in profit from its June quarter of 2018, a fall of almost 47%. Khadim saw a fall of 55% in its net profit, a very high fall from where it was 1 year back. Although the company's revenues are increasing, its profits are decreasing, meaning there is some kind of margin pressures on these companies. Even though companies' sales are increasing, the company is not managing or not able to manage its profits very well. Superhouse has seen a 13% fall in its sales but a 3% growth in its profits. So this sales is a very important value, and we should not see a negative, or at least in our companies, whenever the sales is going negative, it means the top line itself is under pressure. And when the sales are dropping, it means the demand for the company's product is not there, or the demand for the company's product is diminishing. So we have to be very careful when we are analyzing the sales data. The sales, even though the profit may go down in 1 year, sales should always be in an uprise or an uptrend. Next, let us look at the net worth of these companies. That is what is the actual size of these companies, not the market cap, but the actual value of the company when the company goes for liquidation, for example. What is the actual value of the company after the company sells all its assets, clears all its liabilities, and what remains with it is its net worth, which would eventually go to the shareholders. And against that net worth, if the company has any contingent liability, we will look at that. Contingent liability are those liability which are not accounted for in the P&L account or any of the financial statements. Rather, this contingent liability is shown separately in the notes to accounts, and we have to be very careful that contingent liability should not exceed a certain percentage of net worth. In this case, I don't want the contingent liability to exceed 20% of the net worth. Now, contingent liability could be anything like a court case going on with the income tax office or income tax department for that matter, and it could be some kind of bank guarantees, any liability which has not arisen till now but which may come up in the future. Bata was the overall net worth of Bata was around 1,700 crores, and its contingent liability was just 44 crores, just a 3% on its net worth, a very low contingent liability. So this is good. The highest contingent liability was of Mirza International at 15%. That is 91 crores of contingent liability on a net worth of 612 crores. Both Bata and Relaxo are a high net worth companies of above 1,000 crores, and the other three are small cap, or rather below 1,000 crores of net worth. Contingent liability for rest of these companies is very low compared to the net worth. Next, let us look at the debt to equity ratio, which almost all investors are familiar with. This ratio basically tells us how much debt the company has against the equity contribution by the shareholders. Now, when the debt portion goes way above the equity, that would then entail a higher interest payout or a higher interest cost to the company. We don't want a company's debt to exceed more than one times of equity. Even if the debt to equity is equal, that still is okay, but anything above one times then needs to be investigated if the company is getting that borrowings or that debt for the growth of the company, and if that debt is at a low interest cost. So even if the company's debt to equity goes above 1, but the company is receiving that money or borrowings is at a low interest rate, then that is an advantage for the company to grow with that borrowed money. But when the debt payment or the debt taken up by the company is not at a reasonable interest payment, then the company's payout on interest itself will be a big problem in terms of servicing that liability of interest cost. Bata is a debt-free company, whereas the total equity contribution was 1,747 crores. This is the equity plus the reserves of the company. Relaxo Footwear's debt was very low at 0.1 times its equity. The total debt is 112 crores against the total equity of 1,100 crores. Mirza and Superhouse debt to equity is 0.6 times. So this is all, in fact, all of these companies have a below 1 times of debt to equity. So this is all good. Next, let us look at the debt position 3 years back and compare that with the current debt of the 2019. This will help us understand whether the company's debts have increased or decreased over a period of time. Bata 3 years back also was a debt-free company, and even today it is a debt-free company, so that's a very good thing. Relaxo's debt was 236 crores 3 years back, and in 2019 it has decreased to 112 crores. So this is a good thing. The company has managed to decrease or has been paying off its debt every year since the last 3 years, and now it is almost half of where it was 3 years back. So this is a good sign. Mirza's debt in turn has increased from where it was 3 years back. So we generally, even if the company has a debt, we want it to be decreasing instead of increasing. And in the earlier chart we saw through debt to equity ratio that most of these companies debt to equity position was a very comfortable, in a comfortable manner. Mirza's debt has increased to 357 crores in 2019 from 205 crores. Khadim debt is almost very near to where it was 3 years back. Even Superhouse debt was very similar to where it was 3 years back. Next, let us look at the debt to profit ratio. This ratio would help us understand how much the company's debt is compared to what it is earning as profit in the latest year. As we saw, the total debt, Bata India was a debt-free company, and it is earning profit of 331 CR in 2019. So this is a good value to look at. Relaxo's debt was 112 crores, against which the company earned 175 CR of net profit. So the company can easily pay off this debt using the current year's net profit if it wants to. So this is also very good. But Mirza International's total debt was 357 CR. Although we saw that against the equity it was alright, but in terms of profit generated on the total debt or when comparing it with the debt, it is very low. So the company would require 7.3 years of the profit. If the company keeps generating a profit like this at 48 CR, it would require 7.3 years to pay off this debt. So this is not a good value. Khadim's debt to profit was 5.2 times. So I don't want the debt to exceed more than 7 times its profits. Khadim's total debt was 109 CR, against which in 2019 it earned 21 crores. So that's a 5.2 times multiple. Superhouse was quoting at 9.2 times debt to profit. Again, a very high value. It would require 9 years to pay off this debt of 176 CR. This is of course assuming that the company would pay entire net profit. Then that also if the company has managed to convert that net profit into cash and not pay any dividend or not do use any of these profits for growth, which is a little absurd because the company can't use entire net profit to pay off the debt. Next, let us look at the interest coverage ratio. This coverage ratio helps us understand whether the company can service its interest liability on the borrowings, and is the EBIT or the earnings before interest and tax enough to pay off this interest cost? Is it generating EBIT to pay interest cost? Bata's earnings before interest and tax in 2019 was 495 cr, and the interest cost was just 14 cr. Although we saw earlier that the company it's a debt-free company, it still has a 14 cr of interest cost, which is a 15.9 time multiple. That is, the EBIT was 15.9 times higher than the interest it paid. So we want the interest coverage ratio to be at least above 4 times. Relaxo interest coverage is 29.6 times. Its EBIT was, or profit generated was 274 cr. This is not the net profit but the top line profit. So 274 cr of EBIT, against which it paid just 7 cr of interest cost. Mirza's interest coverage has fallen below 4 times. Its earnings or profits generated 110 crores. On that, it paid 34 crores as interest cost or finance cost. That is a 2.7 times multiple. We want the multiple to be as high as possible. That is, the EBIT should be as high as possible against what it has to pay as interest cost. In fact, Khadim and Superhouse also have seen a fall of interest coverage below 4 times. Next, let us look at the promoter holdings of this company, and if any of these promoter holding has been pledged. We don't want the pledge of any shares, or almost we should not want the shares pledged to be exceeding 20% of the promoter holding, and the promoter holding should be as high as possible. That would basically give us a comfort or protect us against company not being managed properly. If the promoter's stake is high, then the promoters are also have a high incentive to keep growing the business in an efficient manner. All of these companies promoters are holding above 50% in the company, and none of these companies have pledged any of their shares. Let us look at what is the raw material cost for these companies as a percentage of sales in 2019. This would help us understand which companies would do well, because these companies have a good control over their raw material cost. Bata's raw material cost as a percentage of sales was 44%. That is, whatever revenue generated through sales, 44% was the raw material cost. So these are all good. Most of these companies are within a range of less than 60%. Superhouse raw material cost was quite low at 38%. So it needs to be investigated if a certain company's raw material cost is very high compared to the sales, and a certain company in the same category or in the same sector has a very low raw material cost. That also should be investigated as to how this company is managing to reduce its raw material cost when compared to the top companies. Both Bata and Relaxo, if we see, are very nearby to 44% to 47%. As the raw material cost increases, it directly affects the net profit of the company. Let us look at the debtors to sales ratio or debtors turnover ratio. Here we are trying to understand how much payment still needs to be collected from customers against the current year's sales. Bata's current year's sales were 2,900 crores, and it has to just receive 65 crores from its customers. That's a mere 2.2%. So it's a very good value. Relaxo also has to just receive 8.3% from its customers against the current year's sales. So we don't want this ratio to exceed 30%. All the other three companies also have kept or managed to keep their debtors at a below 30% of their sales. Let us look at the debtor days, or how fast these companies are collecting payment from their customers. Bata's total debtors were just 2.2% of the sales, which we saw earlier in the previous graph, and it is collecting within 8 days in 2019, and 3 years back also it was collecting within 11 days. In fact, it has improved its efficiency in collection of payment from customers, and it has managed to collect faster within 8 days. So this is an important ratio to look at because it shows an efficiency of the management, and for Indian companies efficiency of the management is very important. So there are a few ratios which will help us understand the company's management and how they are dealing with their customers and how efficiently they are collecting payment from the customers. Relaxo also has managed to slightly increase above where it was 3 years back. So it was taking 24 days to collect payment from customers 3 years back, and now it has increased to 31 days. Sometimes the companies are under pressure to increase credit to their customers so that they can also increase their sales. Mirza's collection days has gone up by almost twice where it was 3 years back. So we don't want a very high increase that shows inefficiency. Khadim's collection days have gone up 3 times from where it was 3 years back. And Superhouse collection period is very high at 67 days and 79 days. This shows that the company has to give a high number of days to its customers to pay them. Now as the payment days increases or the collection days increases, there is more pressure on the company on their working capital. If the customers are not paying to the company within a certain period, then the company would need to take help of the internal revenue or internal sources to keep generating higher and higher sales. Next, let us look at the debtors to creditors position. That is how much payment the company has to collect from its customers vis-a-vis how much it has to pay to its suppliers. Now, if the customer or rather if the company is working on the creditors' money, then that shows that the company has a high reputation in the market. The creditors are willing to give it more time and more money to work interest free. Now, it could also be the other way around, meaning if the creditors are very high against the debtors, then we also have to question why the company is not paying its suppliers on time, or why the creditors are more than the debtors, or why there is a variation between the two. Here with Bata, we see that the company has to collect just 65 crores from its customers, but it has to pay 528 crores to its suppliers. So that's a very high difference or multiple. So we need to ask whether the company is genuinely getting a high value from their suppliers rather, and we have to ask a question why the company or why the company's creditors or suppliers willing to give 528 crores of their money to the company to use, whereas it just has to collect 65 crores from its own customers. Relaxo's debtors to creditors ratio is almost very equal, that is just 1.1 times between each of them. Mirza's debtors are 156 against creditors of just 81 crores. Now, as I mentioned, if the creditors are low, it means the company is paying faster to its suppliers and collecting slower from its own customers. Khadim's ratio is also almost similar, that is, debtors and creditors are almost equal. Superhouse is almost similar to Khadim. Next, let us look at the average OPM of the last 5 years, that is the operating profit margin of these companies, and compare it with the latest net profit margin of 2019 and 2018. Bata managed an operating profit margin of 13.4%. My benchmark is 15% of OPM at least over a period of 5 years, as from that OPM tax, depreciation and interest cost and any additional expenses or exceptional or extraordinary items or expenses needs to be deducted. So then we would get a net profit margin of around 10% or so. So Bata's OPM is low at 13.4% and below my benchmark. Although the latest NPM has gone above 10% to 11.3%. In 2018, the NPM was low at 8.5%. Again, a negative mark for the company. Relaxo's OPM was also low at 14.5% and net profit margin was just 7.7% in 2019 and 8.3% in 2018. Again, a low value for all the three ratios. Mirza's OPM was high at 16.2, but the company's margin or NPM was very low at 4.2%. So why, if we have to ask a question, why the company's OPM is so high, yet the company is not able to or manage to convert that OPM into NPM? Is it because the depreciation cost is very high, or is it because the interest cost is very high? So that needs to be investigated. In 2018, the NPM was quite high at 8.1%, and in 2019, it has dropped to almost 50% of that. Khadim's OPM was very low over a period of 5 years at just 8.6%, and in 2019, NPM is very low at 2.7% and almost 50% of where it was in 2018. So there's definitely some margin pressures on these companies. If you look at Superhouse, that too has a very similar story of 9.3% OPM of the last 5 years, and in fact a very low NPM in 2019 and 2018. Next, let us look at the current ratio, that is, how much was the current assets and how much current liabilities the company has. That is, if the company has to pay off all its current liabilities or those liabilities which will arise in this year using the current assets, would it be able to pay off those liabilities or service those liabilities? And then we'll look at what is the working capital requirement of these companies. Bata India's total current assets were 1,900 crores, against which the liability standing for this year is just 630 crores. So the current assets are very good at 3.1 times of the liability it has to pay. So it has an excess working capital of 1,318 crores. So the company is in a good liquid position or good liquidity position. Relaxo, Mirza, all of these companies' liquidity position is very good. Mirza's total assets were 691 crores against a liability or current liability of 128 crores. Generally, a ratio of 2 times is good, or even higher above 1 is good. Next, let us look at the total assets of these companies at its acquisition cost. This is the total assets which are still in on the books and they have not been completely depreciated till now. And then we'll look at what is the total depreciation or accumulated depreciation on this gross block. The gross block is basically the assets of the company at its acquisition cost or at cost price. And then we're trying to understand how much of this gross block has been depreciated till now. The accumulated depreciation is the total reduction in the value of the gross block. Once we reduce the accumulated depreciation from the gross block, we get the net block or net fixed assets, which again would then go to the P&L account or depreciated to the P&L account in the future years. Here, accumulated depreciation means that this is the total depreciation which has already been accounted for in the past in the P&L account, meaning these expenses of depreciation has already been transferred in past in the P&L account. Till the time the total gross block or total assets or assets in the gross block are not completely depreciated, the gross block will be shown separately and the net block will be shown separately. So the company's total assets as of today was 567 crores for Bata India. Of that, almost 45% has already been depreciated and transferred in the past years to P&L account. Now only 50% is left over to be depreciated in the future years. Relaxo's gross block, again, this ratio is also very important to look at because it shows if the company is managing its depreciation cost efficiently. Relaxo's total assets were 1000 crores. Of that, just 167 crores has been depreciated till now. So again, it's just a 16%. So we have to understand that balance of this 1015 minus 167, that value still needs to be accounted for in the P&L account in the future years. So there will be constant pressure of the depreciation on the P&L account. Mirza International's half of its assets have already been depreciated, so only the balance between 689 and 280 needs to go to the P&L account in the future years. Khadim's was 27% of the assets were already depreciated, that is gross block. Superhouse accumulated depreciation was just 18%, so the balance will be still going to the P&L account as expense in the future years. Next, let us look at the net block, which I have already explained. Gross block minus the accumulated depreciation of the previous chart, we get net block. Now this is the assets of the company the company is holding after removing out the total accumulated depreciation. And on this assets that the company has, what is the depreciation rate being charged to the P&L account? Bata's total net block now stands at, or total assets now stands at 315 crores after removing out the accumulated depreciation. On that, it is transferring 64 crores to the P&L account in 2019. So that's at 20%. So the higher the better, because that shows the company is not manipulating. It's by showing less depreciation in the P&L account, they can increase the profit. But if the company is transferring a high portion of the assets to the P&L account, then the profit will go down. So there is no manipulation as such. But if the company wants to pay less tax, then they can reduce the profit by showing more depreciation. Relaxo's total net assets still standing are 848 CR, against which it is transferring 62 CR every year to the P&L account. So we can see a difference between Bata and Relaxo, where Relaxo is transferring just 62 CR on 848 crores of assets, net assets. Bata India is transferring 64 crores on net assets of just 315 crores. So that shows that Bata India is transferring a higher portion of net assets to the P&L account as depreciation, and that's a good sign. Basically, it's not manipulating the depreciation being transferred to the P&L account. Mirza is transferring a very small percentage or depreciating at just 9%, and Superhouse is transferring at just 7% of the net assets. Khadim is transferring at 14%. So these are the different depreciation rates being charged by these companies. Next, let us look at the inventory turnover into sales. That is, what is the company's current inventory holding, and of that, what is the sale? Against that, what is the sales? So we understand whether the company is managing to convert, or how many times over it is managing to convert its inventory into sales. And we'll also look at what was the inventory turnover multiple 3 years back. Bata's current inventory turnover was 3.7 times, and even 3 years back it was converting its inventory into sales at around 3.6 times. So it is very nearby to each other. In fact, Relaxo has been converting most of its inventory 6.4 times more into sales, and 3 years back as well it managed to convert at around 5.7 times. So in recent year, it has managed a higher turnover. Now we have to be careful that this is just for an understanding, and we cannot take this as a value for or as a basis for investment. This is just to understand what is the turnover of, or how much time sales is more than the inventory of the company. So if the company's inventory holding is very less in 2019, then this value will shoot up. And if the inventory value is very high against the sales, for example, if the company has got a big order at the end of the year and it is accumulating more inventory into the business, then the ratio would fall. That does not mean that it's a bad thing or it's a good thing. If the ratio is high or low, it does not mean anything as such, except that we can use it to look at how the inventory is getting converted into sales over a period of time. And if you look at the overall company or overall sector, we can understand how these companies are managing to convert their inventories into sales. So this concludes my analysis for time being in terms of graph. Let us go back to the Excel sheet, and I will quickly give it a score for each ratio depending on what that ratio values are, and then we will analyze which company are good. Anyways, we have already understood that both all the three, Mirza, Khadim and Super, have some or the other issues in terms of ROEs and in terms of cash, free cash conversion, even cash flow from operations. Only Bata India and Relaxo, for that matter, for me as of now, without putting scores, I can say that only Bata and Relaxo can be or are investable ideas as of now. So I have given scores to all of these companies. The scoring system is from -5 to +5. That is, if a certain ratio is below the benchmark, then it would get a negative scoring. And if the higher, the better the ratio, the better the score. And the lower the ratio, the lower the score. So I'm not going to analyze these numbers all over again, as what I've analyzed in the graph is exactly from these numbers. So I'll be keeping this picture on for 5 seconds each. Anyone interested in noting down the values of these companies can do so. Then I'll be analyzing cumulatively the total ratios into different metrics, or rather 6 different metrics, and we'll try to understand how these companies have scored in terms of different metrics. Okay, what I've done now is grouped all of these 40 ratios approximately into 6 different categories, starting with efficiency, and have given the highest weightage to efficiency metric. Efficiency would cover asset turnover, that is, how many times over the company has converted its assets or its total assets into sales. Contingent liability, is it within a reasonable range of the net worth? What is the debt against the equity? Whether the company is able to pay its interest cost or its liability of interest on the EBIT it generates. What is the debt against the profit, or how far away the total borrowings are against the profit that the company is earning in the latest year? How much payment still needs to be collected from the debtors against the sales the company has generated in the recent year? How fast the company is collecting payment from its customers using debtor days? Inventory turnover would again tell us how many times over the sale is, or how much sale is compared to the inventory of the company. Then we'll also understand whether the company has depreciated most of its assets to the P&L account in the past years, and what is the depreciation rate on the net block. All of these ratios would show efficiency of the company. In the cash flow metric, we'll understand whether the cash has been converted into profit, how much is left over as free cash out of that cash earned for both 5 years as well as latest year. Then we'll look at the growth metrics. How how is the sales and the profits growing over 5 and 3 years, as well as in the recent year, as well as in the quarterly analysis. What is the net worth of the company? How is the profit growing year on year? And how is the profit growing compared to its 5 years average? What is the growth rate in the ROE, which is again a very important metric that we will see. Written metric would cover the earnings yield, the ROE, return on equity, what is the profit generated on the shareholders' money, what is the profit generated on the total capital employed into the business, what is the profit generated on the assets, then what is the OPM or operating profit margin, net profit margin, dividend yield. Solvency metric would cover the promoter shareholding, promoter pledge if any, current and quick ratios. And finally, the valuation metric, which I've given the least weightage, because only after we understand how efficiently the company is managing its resources, is the profit getting converted into cash, is the company growing, what is the profitability of the company, is it solvent enough, then we can look at the valuation and try to understand if whether these companies are within our comfort zone to buy and hold for a certain period. As we can see, Bata India has gone or has received almost all highest scores, even in terms of efficiency, cash flow, growth, return metrics, solvency, as well as valuation. So it has got the highest score or highest ranking of 711 points. The second highest score is by Relaxo Footwear at 589 points. The lowest score was received by Khadim as well as Mirza at around 322, 342 and 392. So all of these three companies are within that same range and have occupied 3rd, 4th and 5th rank. Relaxo in terms of efficiency has done best along with Bata. In terms of cash flow, Relaxo, Bata and Superhouse have done well. That is, it has managed to convert most of its profits into cash. In terms of growth, Bata and Relaxo have managed to grow their sales and profits at a high rate. In terms of written metrics, that is profitability metrics, again both the companies have scored a high value. Solvency wise, Mirza and Bata have scored the highest. In terms of valuation, Bata India has scored second highest along with Superhouse. So these are the most economical in terms of price, purchase price and buying of company. So if you want to buy, these two companies are at the best valuations, and Relaxo and Khadim are the most expensive in that sense. So if you have watched up till now, I would appeal to you to subscribe to the channel and press that bell icon, which would just notify you as to whenever I release a new video. Thank you for watching this video.